welcome back to the course on Forex trading. In this section we will be talking about technical analysis, and in particular I will provide you with your technical analysis arsenal, a comprehensive base of technical analysis skills and tools that will help you cover most of the trading situations you will find yourself in. Before we proceed, I would like to underline that whatever we talk about in this section are my views, and all of this is derived from my personal experience of trading. The other tutorials and courses that you might find on the internet, they might have different views and a different variety of skills and techniques to use in the Forex market, and that's totally fine. You're more than welcome to, in your free time, to explore additional skills. However, what I provide you is, in my view, the most important things that will help you in most cases. And to start off with, I would like to quote the Pareto principle, which states that 80% of the effects come from 20% of the causes. And this can be applied to things like 80% of peas are usually contained in 20% of the pods in a garden. 80% of sales of a lot of companies come from 20% of their clients. 80% of work can be done in 20% of the time. That's the Pareto principle, and it applies in lots and lots of situations in life, and I personally believe it also applies in technical analysis. And it's not a coincidence that I call this section Technical Analysis Arsenal, because there's a limited number of skills and techniques that you need to know to cover most of the situations you'll come across. And I believe that the techniques that I'm going to cover in this section are about maybe 20% of the techniques that you can find out there as a starting out trader, and they will cover 80% of the situations that we'll come across. And you'll see that in our live trading. We will limit ourselves to these 20% of techniques, and we'll be able to trade in most of the cases. And so a lot of courses and a lot of books get technical analysis, make it seem very complicated and confusing, and I want to avoid that. In this course we will look at a limited number of the most efficient, most powerful techniques, and that way they will seem simple, and they are simple, and they will cover most of your trading. Let's sum up in 3 bullet points what we're going to cover in this section. We'll cover techniques and skills that will get you through 80% of situations on the Forex market. And that doesn't mean that you won't know what to do in other cases. It just means that you won't have to trade in other cases, and you'll find the right situations for these skills and techniques. Not at all, it doesn't mean that you will have any difficulties or trouble. It just means that you will trade when you find these techniques to be working on the market. We will make everything very simple, broken down into extremely intuitive steps. That's the way it should be. Technical analysis is simple in its nature. And everything should be clear. Everything will be clear in this section, because it is important to understand the principles and how they apply. There can't be any gray areas. Technical analysis has to allow you to create a strict trading strategy which will tell you whether to enter the market or not to enter the market. So those are the 3 things that we'll be aiming for, and that's what you will get from this section. Trends and flats. So one of the most common themes on the Forex market is a trend. Let's try to understand what a trend is exactly. For example, this is how the price has been moving over a certain period of time. Then, as you can see here, we can draw a diagonal line underneath the price, which the price seems to be bouncing off. This line is called the support line. It indicates an upward trend. It means that the price is bouncing off upwards of this line and continuing its upward movement. And so what you can expect in a situation like this is that the price will once again come close to the line and bounce off it and keep moving upwards. And that's how you use a support line. So if you notice that the price has bounced off a diagonal line a couple of times in a row, then there is a good chance that it will bounce off the support line one more time, or at least one more time, and that's how traders using technical analysis would enter into a buy order. A downward trend is very similar, but it's just happening in the opposite direction. So here we can draw a red line above the price, and which is kind of not letting the price go up, which is forcing the price to go down. And this this line, therefore, is called a resistance line. And once again, here you can expect that the price will go towards the line, and there's a high chance that the price will bounce off the line again and continue its movement downwards. So this is called a downward trend, and the line is called a resistance line. And the third type of market is a flat market. In this case, we can't draw a support line or resistance line because the market is kind of flat. It's moving sideways. Some people call a flat market a sideways trend. I kind of try to stay away from that definition because there is actually no trend in the market, so why bother calling it a sideways trend? Finally, in regards to trends, it's always important to check the overall trend on the market. So if the euro dollar is going down, then whatever your other technical analysis suggests, it's always more favorable to trade downwards. If the British pound dollar is going up overall, then you would favor more the signals that tell you to trade upwards. So it's called trading with the trend, and you'll notice that we will be doing that in our live real Forex trading in this course. Alright, so we've already talked about support and resistance trend lines. Now we're going to talk about support and resistance levels. So support levels. Let's imagine a situation where we have a downward trend in the market. And in this case, a support level is a horizontal line, which is called support level, which represents a barrier for the price. So when we'll find out how to look for support levels in a few minutes, but right now let's see what a support level does to the price. So as the price approaches the support level, traders become hesitant because they don't know what will happen. They don't know whether the price will cross it or whether the price will bounce off and move in the opposite direction. So generally you'll notice a kind of consolidation on the market, and then one of the following three things will happen. Either the price will bounce off the support level and go in the opposite direction, or the price might test the support level a little bit, cross it, and then bounce off and go in the opposite direction. Or the price can actually cross the support level and there'll be a massive impulse in the direction of the trend. So now resistance levels. They're very similar, but they're the opposite. They're above the price. So resistance level puts pressure on the price and doesn't and acts as a barrier for the price going upwards. And once again, generally speaking, there's three possible outcomes. Either the price bounces off the resistance level and goes down, or it can test the resistance level and then go down, or it can cross the resistance level and there'll be a strong impulse in the direction of the trend. There are two main types of support and resistance levels, and these are historical and psychological. Let's have a look at the historical type first. So historical levels. Looking at this chart, can you identify any horizontal lines that have been tried and tested by the price more than one time? We can see one of those lines right away. It's this horizontal support line, and the price tested this line over here at first, and then it came back to this line here. And so what can we anticipate from the price's future movement? Well, we can anticipate that if the price does go towards this support line, then something will probably happen over there. So, and that's how you establish support and resistance levels, the historical type. You look at what happened in the past and you see that, oh, wait a second, so the price was hesitant to cross this level previously, or there was some sort of consolidation there in the past. So maybe that same thing or something might happen when the price approaches this level. And more often than not, that's exactly what will happen. There will be some sort of abnormal movement when the price gets to this level, and that's what we take advantage of. The second type is psychological levels. So they're a bit different in the sense that the price is just in a trend, and then we identify a level which is very often a round number. So for example, 1.5000. That is a number that plays with the minds of traders, and because they don't know whether the price is going to bounce off it or cross it. Mathematically speaking, there's nothing special about 1.500. It's no different to 1.650. But at the same time, in a consumer's head, in a normal person's head who walks the streets and lives his life, in his head, his home currency being traded at above 1.5 and below 1.5 are two distinct things. So you might not care whether it's 1.6 or 1.7, but he'll remember if it's 1.55 or if it's 1.45, because that kind of difference sits in your head. Or same thing if it's like 2.0. Like you would know if your home currency or somebody's home currency is trading at $2 per unit of their currency or below or above. So it's kind of a strong level because it's a round number, and traders tend to be hesitant when the price approaches this level because they don't know what will happen, whether the price will go down or up. And same thing as with historical levels, something happens. One of the three things that we discussed normally happens over here. So let's have a look at an example from a real chart. Here I've got the British pound dollar weekly chart, and I just took this out of my terminal, so this is fresh as of today, 4th of February 2015. And as you can see, the British pound dollar currency pair is approaching, or has approached, this blue support line, and guess what it is? It's 1.5000. And let's have a look here closer. So as we discussed, traders don't know what's going to happen, and these kind of round numbers play with their heads. They're anticipating some sort of reaction or action on the market, and generally the price goes into consolidation for a certain period of time. So traders don't know what's going to happen, and here you can see that's exactly what happened. So before the price reached this level, we had 6 weeks in a row we had bearish candles. You see those 6 white candles going down? There were 6 candles in a row, and as soon as the price got to this psychological level, it stopped. We got 2 bullish candles. So the price went in the opposite direction, and that's because it's testing the level. It doesn't know, nobody knows whether it's going to cross it or whether it's going to bounce off. And so now there's like a balance of power of bears and bulls, and sooner or later one of those 3 things will happen, and we'll see a strong movement afterwards. And in this particular case, you can see that the psychological level is also a historical level. And that's quite common with psychological levels because they tend to be very significant throughout history. So back in January to July 2013, the price tested this psychological level 3 times. And as you can see, it was unable to cross it, and that's when a massive impulse happened and the price went upwards and reached somewhere around 1.7 American dollars per British pound. So now it's back here at 1.5000, and everybody's waiting to see what will happen. So to sum up, there are 2 main types of support and resistance lines. These are trend lines, which are diagonal, and these are levels, which are horizontal. And there are 2 types of support and resistance levels: historical levels and psychological levels. And all of them act as barriers for the price. And when the price gets to them, it either bounces off or we see an impulse when the price crosses these levels. Let's talk about channels for a minute. Here we've got an upward trend, and as we discussed previously, we can draw a support line which represents a diagonal which is kind of guiding the price, and the price keeps bouncing off it in its journey to the top. Now what we're going to do is we're going to take this diagonal and we're going to copy it, and we're going to put it above the price. So there it is. It's got the same angle as the first one, and it's sitting on one of the highs of the price. So once again, as you can see here, the price is also bouncing off this diagonal as well, and bouncing downwards. The price is kind of moving in a channel or corridor. Now what are we anticipating from the price going forward? Well, right now we are probably expecting for the price to bounce off the top border and then to go back up. This is where we would enter into a buy order. So once the price has bounced off, we would wait for it to hit this bottom border of the channel. We would enter into a buy order, and if the price goes in our direction, once it hits the top border again, that's when we would close our trade. So it's important to note here that in an upward channel, it is recommended to trade only buy orders. And why is that? Well, let's take a few steps back for a second. At this stage, we're anticipating for the price to go down. So we could technically conduct a sell order, but it's not advisable for two reasons. First of all, we'd be trading against the trend, and that's something we said we shouldn't do. We should always trade with the trend. And second, as you can see here, the downward movement is actually smaller than the upward movement. So in an upward channel, if you create sell orders, you will always earn less than if you create buy orders. So that's another reason why in an upward channel you should only trade buy orders. Next, we're going to look at a downward channel. So here we've got a downward trend. We can draw a resistance line. If we copy that line, we can see that very often the price will also follow the copied line. So it won't break through it, it will bounce off that line. And channels are very common on the Forex market, and you'll see this from our live trading on a real account further down in this course. So here we're expecting the price to go up, then we'll conduct a sell order, and we'll close our order once the price reaches the opposite side of the channel. So once again, in a downward channel, it is advised to open sell orders, because you would be, in this case, you'll be trading with the trend and you'll get longer movements. And so those are the two main ways of trading channels. It's actually one way, but in two different types of channels. And it's always trading inside the channel. And more often than not, the price does stay in the channel. But sooner or later, of course, the price will break the channel. And that's why there's an alternative strategy where, in this case, instead of opening a sell order, you would open a buy order, and you would expect the price to go somewhere out of the channel. You would use this strategy when your other analysis is telling you that this channel is getting too old and the price is going to break through it. So when a channel is quite new, there's more chances that the price will stay inside. When the channel has been around for a while, the chances of the price breaking out are constantly growing. Both strategies are valid. Depends on the situation and what your other technical analysis tells you. So to sum up with channels, direction, trade with the channel, stay inside the channel. It's more likely that the price will bounce into the channel. There's an alternative strategy, which is a breakthrough strategy, and that is used when you expect the price to break free from the channel. Welcome back to the course on Forex trading. In today's tutorial, we will be talking about the triangle pattern. Now, the triangle pattern is a very powerful yet extremely simple formation on the Forex market, and right now we're going to learn how to use it and make profits with it. So here we've got a chart, a hypothetical chart that's kind of moving sideways, and if we draw a line above and below the chart, we'll see right away that the price is in a triangle formation. Where can it go from here next? Well, it can continue going in the triangle, and more often than not, that's exactly what happens. The price keeps progressing in the triangle. But then there's an issue. There's nowhere to go. The triangle ends. And that's exactly when this happens. The price shoots out. Now, the shootout can go up or down, depends on the situation. The outcome can be different and often, very often, unpredictable. However, the main core concept of the triangle is the fact that the amplitude of the price movements is decreasing. So you can kind of witness a consolidation in the market. And it's not a coincidence. It means that there's something happening in the world or in the traders' minds that is forcing them to slow down their trading and is increasing the level of uncertainty for this particular currency pair. And therefore, the market consolidates, and then bam, all of a sudden something happens, a movement picks up, and it shoots out. So more often than not, it will happen exactly in this way. So the triangle will progress towards very close to its end, and then the market will exhibit an impulse and the price will shoot out up or down. And that's exactly what we will be taking advantage of. So the triangle is also a very good pattern because it actually gives you targets. So if you measure the base of the triangle and then you copy this measurement to the place where you think the price will shoot out, then an aggressive target is exactly the size of the base. But it is always recommended to go with the more conservative target, which is more reliable, half of the base. So if you measure half of the base from the point where you think the price will shoot out, that's where you should set your take profit. So let's look at the same situation, but when the price shoots out downwards. Here you'd also measure your base, copy it over there, and set your take profit at about half the distance of the base. So that's all good, but in reality we don't know which way the price will shoot out. So what do we do? Do we buy or do we sell? Well, this is the beauty of trading a triangle, and that's why I love the triangle pattern so much, is because the price amplitude is narrowing down and you know, or you're forecasting that with a very high probability there'll be an impulse, but you don't know which way. But on the Forex market you can set stop orders, you can set pending orders, and that's exactly what you should do in this case. So instead of buying or selling and taking our chances with that, what we're going to do is we're going to set two pending orders, one buy stop order and one sell stop order. So whichever way the price goes, we're going to earn a profit. As long as there is an impulse, it doesn't matter whether it's upwards or downwards, we can earn a profit from that. And that is a massive advantage of technical analysis over fundamental, because in situations like this, you don't have to predict where the price will go, you just have to predict that it will go somewhere. And so we set these two orders, and the take profit of each of the orders is set at about half the base of the triangle. So that's exactly how you trade the triangle, and moreover, further in this course you will see a live example from a real account where I do exactly that, and the triangle does shoot out and we do earn a profit. It's just mind-blowing how well this strategy works. So to sum up with the triangle, three main points. First of all, triangle means market consolidation, and it's one of those instruments of technical analysis that can actually picture the psychology of traders on the chart. So that is very powerful. So it combines technical analysis and sentiment analysis in one pattern. The second point is that the most likely exit out of a triangle is an impulse. Doesn't happen 100% of the time, but definitely happens more often than not. And the best part about this is you don't have to predict which way the market will go. All you have to do is set a buy stop and a sell stop order, and whichever way the market goes, you have a good chance of earning a profit. And finally, the triangle gives you a defined target, which is a very strong advantage of this pattern because it makes it straightforward and very easy to incorporate into your trading system. So, Fibonacci levels. So who is this person Fibonacci? Well, the real name of Fibonacci is actually Leonardo of Pisa. Fibonacci is kind of a nickname which he got, and most likely it meant a good son was born. He lived in the 13th century, and he's most famous for his Fibonacci sequence. So what is this Fibonacci sequence? Well, let's imagine a sequence of numbers which starts with the number 1. The second number is also 1. And then going forward, every next number is equal to the sum of the previous two. So the next number in this case would be a 2. The next number after that would be a 3, because 1 plus 2 is 3. The next number, 2 plus 3, is 5. The next number after that is an 8. I'll let you guess what the next number would be. That's right, the next number is 13. And so on, just keeps going forever. So what's so great about this Fibonacci sequence that makes it famous? Well, I'll show you right now. Let's quickly plot the number 1 and number 2 on a horizontal axis. Now what we're going to do is we're going to go through the sequence and take every number of the sequence and divide it by the previous number in the sequence and plot our answer on the same axis. So 1 divided by 1 is equal to 1. We've plotted it with an orange cross. Now let's divide 2 by 1 and we get 2. 3 divided by 2 is 1.5. 5 divided by 3 is 1.666. 8 divided by 5 is 1.6. 13 divided by 8 is 1.625. 21 divided by 13 is 1.615. So you kind of see where this is going. The crosses are getting closer and closer to one specific certain number, and that number is 1.6180339, and so on. And this number is known as the golden ratio, which is usually represented by the Greek letter phi. Phi is equal to approximately 1.618. Alright, so by now you're saying, Kirill, you're boring me with all this math. What's the purpose? What's the point? Well, let's have a look at some of the examples of where you can find the golden ratio that will probably blow your mind. First of all, if you measure the distance between the edge of your fingertips and your wrist, and then you measure the distance between your wrist and your elbow, it will be approximately 1.618. Go ahead, pause this video and give it a go. You'll be surprised at how accurate this is. Next, your fingers, actually, your phalanges on your fingers actually are in the same ratio as the Fibonacci numbers, so 2, 3, 5, 8. If you don't believe this picture, then here's an actual X-ray. Also, if you take any starfish and you measure its base and take it as a 1, then the distance between these two limbs will be 1.618. Now, if you want to get even to more depth, then we'll take the Fibonacci spiral, and you can read about it separately, but it's basically constructed of Fibonacci numbers. And you can find the Fibonacci spiral in many places in the world. For example, a lot of shells follow the same pattern as the Fibonacci spiral. Some galaxies, not all of them, but some spiral galaxies also follow the golden spiral pattern. So it kind of makes you wonder, how come the Fibonacci ratio can be seen in so many parts of nature? Let's take one more example. Let's take the human DNA. And if we measure its width and its length, then they will be exactly 21 angstrom and 34 angstrom, where angstrom is a unit of measurement for various little things. And if you recall, 21 and 34 are actually in our Fibonacci sequence. A coincidence? Maybe. But that's quite a lot of coincidences. And moreover, what's not a coincidence is that there have been experiments that have proven that figures and patterns following the Fibonacci ratio are much more appealing to the human eye than those which do not. So there definitely is some sort of mystery around the Fibonacci numbers, and nobody knows exactly why they're so common in nature and in the world. But what we can do is maybe take advantage of it, including in trading. So what traders and analysts did, well, they said if the Fibonacci numbers are in our DNA, and if they're more appealing to the human eye, and if they're all over nature, let's have a look and see if we can actually find them on Forex charts. So let's see what they found. If this is a just a random Forex chart, then very often you'll find that if you measure the distance of your trend, so the main part, the upward part, and then take it as 1 unit, and then you measure the distance that the price traveled during the retracement phase, you will often notice that the retracement is equal to 0.618 units. Now the best part is that if you divide 1 by the golden ratio, you will get 0.618. So this basically means that if you take your original trend as 1.618, then your retracement will be 1. So basically you see the golden ratio here. We'll just return back to 0.618, which is the inverted golden ratio. So how can you use this in your trading? Well, let's assume that we don't know any of that. We know that there's been a trend and we can see a retracement is starting. Well, now knowing about the golden ratio, we can predict that with a good chance the retracement is actually going to go just exactly up to that 0.618 level. And that means we can enter into a sell order somewhere over there, and we can enter into a buy order once the retracement has completed, knowing that there's a high chance that from here on the trend will continue. So that's all theory, but let's have a look at a live example. This is the Euro-Dollar 4-hourly chart, which I took a snapshot of yesterday. As you can see here, we've got a downward trend first of all, and then we've got a bit of a retracement. So how about we go ahead and measure them? So the downward trend started up here, Then the price went down a bit slower, went down fast, went down a bit, went actually up again, went down, and that was the end of the trend for now. Then the price started moving back up, went down a bit, and then went back up. So we're going to measure the distances between those 3 points. And those lines indicate where our measurements will be. So if we take the original trend, and we take it as 1 unit, then you will notice, and you can take a ruler and measure this on your screen if you like, or even open up the same chart and perform those measurements. You'll notice that the retracement was exactly 0.618. And I didn't have to look for this example. This was the first chart I opened up. Euro dollar, 4-hourly time frame, January 2015. You can scroll through any chart you like, and sooner or later, actually sooner rather than later, you'll find one of these examples. So the golden ratio is very powerful, not only in nature, but also in our Forex trading, and we can use it to our advantage. And you will see examples of this in our live Forex trading further down in this course. By the way, if you're using MetaTrader 4, there's a very handy way to measure these retracements. If you go to Insert Fibonacci Retracement, you'll get a very handy tool which allows you to effortlessly measure Fibonacci retracements. On that note, we'll finish up today's tutorial. Please do leave a review if you haven't yet. I would really appreciate it, and I look forward to seeing you next time. And welcome back to the course on Forex Trading. Today I've prepared a really exciting tutorial for you. We're going to be talking about indicators. So let's jump straight into it. So as you can remember, we talked about that the price has 4 main elements: the high, the low, the open, and the close. So indicators are basically aggregators of these values. So you have a stream of values of high, open, low, close coming into your terminal all the time. And what indicators do is they process these values to kind of give you a different perspective on the market. So let's have a look at a particular example. Here we've got a price chart, and say for instance we take the bar that's most to the right, and we take its high, and then we take its low, and we subtract the high from the low. Well, that difference is called the true range. It just basically indicates what the volatility or the amplitude of the market movement was for today. So that's good. So that's one of the things that you can derive from price, and that's an example of an indicator, because that value, the true range, is not actually given to you by default, but you can derive it from these 2 values. Next, let's take the true range for the next bar, and then let's take the true range for the bar after that, and then we'll take one more true range. So what we're going to do with all of these 4 true ranges is we'll take the average of these 4 true ranges, and that will give us the average true range in the past 4 bars. So that tells you not only how volatile the market was in the current day, but also how volatile the market was over the past 4 days on average. Because if you take one day, you can have an anomaly, or some news might have come out, but when you average it out, it tends to smooth out the effects, and therefore you see a representative picture of the market. So what we can do now is we can plot this average true range on our chart. So let's make some space. We'll move up this chart a bit, and at the bottom we'll have a new chart. So let's plot this calculated average true range under the last bar. So this little blue cross at the bottom represents the average true range for the previous 4 bars. Next, we'll continue like that, and we'll take the average true range for the 4 bars before the current one. So excluding the current one, what's the average true range before that? We'll plot it as well. Let's do that again. Once more, we've got 4 bars, we've got the average true range plotted under the last of the 4 bars. We can do that again and again, and so on. We just keep going as far left as we want to, and we get all these little crosses at the bottom. So now what we're going to do is we're going to connect the crosses with a line, and that's what it looks like. So now what we've actually constructed is the average true range indicator with a period of 4. You can actually take this, find this indicator in MetaTrader 4 and drag it onto your chart, and you'll see exactly this picture. And sometimes traders, they're a bit scared of all these complicated indicators, and they know, they kind of learn the names, they learn what they represent for the market, but they don't know the calculation. Well, this example shows that the calculations behind these indicators are very often very simple. In most cases, they're very simple. You just take the sum of the values from the open, low, high, and close. You do something with them. You take an average and you plot it on the chart. So it's a very good idea to actually understand what's behind the indicators that you're using in your trading, and not only what they mean, but also how they're calculated. And so right now we know that this average to range indicator tells us how volatile the market has been over the past 4 days. And to finish off today's tutorial, let's have a quick look at the average to range on a real chart in MetaTrader 4. So here's a chart, which a snapshot from MetaTrader 4, and at the bottom you've got the average to range with a period of 14. That means that every single element in the average to range represents the smoothed out true range of the past 14 bars, and that's how it's been changing, and that tells you of the market volatility. So right now you can see on the right the true range is somewhere about average, meaning the market is not in its most volatile time. And you can use that in your trading. So maybe your trading strategy tells you that you are trying to avoid volatile times because they're more they bring more uncertainty, and you want to trade during less volatile times. Or maybe you want to trade during more volatile times and take big movements and big impulses. So there's lots of indicators on the Forex market. They're all constructed differently. Have a look around. You'll definitely find some that you like, some that you don't like. In our trading, the one we will focus on is the moving average, and we'll talk about that in the next tutorial. I'll look forward to seeing you then, and until next time, happy trading. And welcome back to the course on Forex trading. Today we're going to talk about the moving average indicator. So personally, I think the moving average is a very powerful indicator. It's very simple, and in Forex, very often simplicity is the key to your success. If you overcomplicate things, then you might miss out on the obvious. So today we're going to talk about moving average. We'll see how it's constructed, and then we'll see a few examples of how to use it in trading strategies, and I'll just give you a few more thoughts on this indicator. Alright, so similar to what we did in this past tutorial with the average to range indicator, let's have a look at how the moving average is constructed. So if we take the past 4 bars and we take the close prices of these bars, and then we plot the average of them, it'll look something like this. Next, if we move to 1 bar to the left and we take the average of the 4 bars there, then we plot it, it'll look something like this. Then if we keep going and keep plotting the average every time, we can keep going as far as we want left, and we'll get a picture like this. Next, we'll connect all these points on our chart with a line and get rid of the crosses. So that's how your moving average indicator looks, and this particular moving average has a period of 4, and that's because of the way we constructed it. We're looking at 4 bars every time. This case is a bit different to the average to range because we don't have to plot this indicator in a separate chart. And you'll notice that on the Forex market and in MetaTrader 4, there are 2 types of indicators. Those that are plotted on the same chart as the price, and those that are plotted in a separate chart. Now in this particular instance, we didn't have to plot it separately because the actual range in which the indicator has its values is actually the same of the chart, as of the chart. So what we're taking is we're taking the average of the past 4 prices, so it will be somewhere there on the chart. Whereas with the average to range indicator, we were taking the difference of the high and the low. So obviously if your high is 1.5 and your low is 1.4, then the difference is 0.1. It's not going to be anywhere near the current values on the chart, so it will be very far down, so you have to kind of plot it on a separate chart. So that's our moving average. Let's have a look at the moving average on a real Forex chart. So that's our euro-dollar hourly time frame chart, and as you can see here, I've plotted the moving average with a period of 48. So in this case, it means that every single value of the moving average represents the average close price for the past 48 bars. And because this is a 1 hourly time frame, 48 means 2 days, so 2 times 24. So it basically means the average close price on the hourly time frame for the past 2 days. And that's how it's been changing. You can see that it went first down, the average, then it started picking up, and then it started going down again. So how can you use the moving average in your trading? There are several methods of using the moving average, but we'll look at the two main ones and the two most simple, straightforward, and most frequently used methods. So the first one is using the moving average as a signal generator. Let's have a look at the chart again. Can you see here that when on the left the price crosses the moving average downwards, it keeps going down? So in that case, when the price crossed the moving average down, you would sell, expecting the price to keep going down. And then when the price crossed the moving average upward, it kept going that way. So you could buy here, expecting that it would keep going that way. And then once again, when it crossed it down, you could sell, expecting that the price would go down. So as you can see, in times when there's a trend on the market, if the price is below the moving average, then it's a downward trend. If the price is above the moving average, then it's an upward trend. So this strategy works during trend times. Unfortunately, it doesn't work during flat times, like when there's no movement on the market, because the price tends to be very close to the moving average, and they can cross over very frequently. So you have to be careful when you use this strategy, but do keep in mind that if you see the price above the moving average, then most likely you are currently in an upward trend. Next, the other way of using the moving average is using it as a support or resistance line. And this is actually very interesting. You will notice that our support resistance line were either trend lines or levels, and that's what we talked about previously. But now we've got a moving support and resistance line. So let's have a look at that. We've got the moving average here, the same one as we talked about. Can you see how on the right, during the uptrend, the price actually bounced off the moving average one time, the second time, and the third time? So that's not a coincidence. That is quite a frequent phenomenon on the Forex market, and if you find, you have to kind of pick the right period for your moving average, which we'll talk about in a minute. But if you pick the right one for the right situation, you can actually effectively construct a moving support or resistance line, which is very powerful. And there are many different speculations why this works. And for example, one of them is because other traders also use the moving average, and when a lot of traders and decision makers for large funds use the same strategy, it tends to work. And in this case, they see the price approaching the moving average, and they know that it's going to act as a support line, so they kind of buy, and then they buy again, and they buy again every time that happens. So this strategy may work for that reason. But regardless of why exactly it works, it's a good thing to look out for. And moreover, in our live trading on a real Forex account further in this course, you will see us use this strategy to our advantage to make profits. And I'll explain exactly how I pick the right period for the moving average and how to better use it in your live trading. And finally, the last remark I wanted to make in this tutorial was that the period of the moving average is very important. Let's have a look at the chart again. So this is the moving average with a period of 48. If you plot the moving average with a period of 12, that's how it will look like. And if you plot a moving average with a period of 150, that's how it will look like. So as you can see, all of them are very different, and they can give you different insights into the market and actually different recommendations to what you have to do. So it's up to you as the trader to pick the right moving average for your currency pair, for your time frame, and for your particular situation. Don't worry, it might sound complicated, but in reality it's very simple, and with time you will get the hang of it, and with every single situation you'll get better and better at picking the right period of the moving average. That's all for today's tutorial. Next time we'll be talking about algorithmic trading and expert advisors on the Forex market, and until then, happy trading. Forex robots. So in MetaTrader 4, Forex robots are also called expert advisors, and the whole topic that we're talking about in today's tutorial is called algorithmic trading. So what is it? What is algorithmic trading, and what are these Forex robots? So a Forex robot can be envisaged as an actual robot, but in reality, it's a program. It's like a computer program which can work through MetaTrader 4. Some programs work without MetaTrader 4, and the concept behind it is that if you launch this program on a Forex chart, it's supposed to bring you profits automatically. So you basically just set some inputs for the program, and you let it run, and it'll just earn you money in the background. So let's talk about this for a second. A lot of traders think this is a hoax, this is not possible, this is, the dream of any investor, that you just do nothing and the money is earned in the background. And to some extent, it is true. It's not entirely possible to just have money coming into your trading account all the time with no effort at all. And there are a lot of scams out there on the market, just in the internet, that will tell you buy this Forex robot and it'll earn you money and you'll be rich and you'll never have to worry about trading again. So 90% or 95% of the stuff you see on the internet are scams. They're just trying to get your money as quickly as possible before their system starts to fail. But the truth is that algorithmic trading is actually possible, and it does work. And I'm a live example of that. I'm a live example of a success that I've had in algorithmic trading. Most of my trading, like, people sometimes ask me, like, what strategies do you use, and like, how often do you trade and things like that. But most of my trading strategies are actually have all been converted into Forex robots, and I have made tens of thousands of dollars just using Forex robots. And actually, I try to stay away from manual trading because of the convenience that trading with Forex robots brings, which we'll talk about in a minute. But I just wanted to emphasize that trading with robots is possible. It does bring you money, and it has massive advantages when you're actually into it, when you know what you're doing. It's not effortless. It's not just switch it on and go away. It does require maintenance. It requires certain inputs from the trader, certain decisions, which robots to put on, which ones to take off, and re-optimization and things like that. But the bottom line is it's possible, and it's highly advantageous. So some of the advantages that algorithmic trading brings to you, as opposed to, or when compared to manual trading, well, first one, of course, is you get the freedom of time. Like the Forex market does give you financial freedom, in terms of, if you master it, you won't have to go to work anymore, and you can trade from any place on the planet. But it doesn't give you freedom of time. You still have to follow your trading strategy. You still have to watch the charts. You still, even at least a couple of hours a day, you will have to sit in front of your computer and make decisions. Whereas when you turn your trading strategy into a Forex robot, you can set it on your chart and just let it run in the background while you sleep, while you have fun with friends and family. And you just have to check up on it once a week, or several times a week. But generally, it frees up the constraints that you may experience when your trading strategy requires you to be in front of the computer. And for me, that's a massive advantage. And like, I even took it to the next level through setting up a virtual private server where my Forex robots run, so I don't even have to use my home computer. So it's just sitting somewhere in a different country, and the Forex robots are running, and I can just check on it once every couple of weeks even, and see that everything's going all right. The second massive advantage of algorithmic trading, which can for some people be even more important than the first one, is the psychological side of things. That when you're trading with your own like hands, and with your own mindset, you have to make certain decisions, and you have to watch the market and like, see your profits and losses. And that can be can have a massive toll on your emotional state. and it can like devastate you when you see a loss, or it can even being happy about a profit. You see, that's a good thing. Maybe you might think it is, but in reality, it's not. Forex should be cold-blooded. Like ideally, you shouldn't be happy about profits, because if you're happy about profits, you're going to be devastated when you see losses. Everything should be calculated, and you'll see that in our section on live real trading, that our risks will be very diligently calculated, and we will know exactly how much we are risking to lose and things like that, so that when the time comes to open a trade, you're not emotionally involved, and that's very important with Forex trading. So what Forex robots allow you to do is they take out the emotional side of things completely. Because it's a robot trading for you, and because you don't even look at the market, all you're relying on is that your trading strategy is correct. You've come up with a good trading strategy, and it's just going to bring you money in the long run. So even if you have 5 profits and 1 loss, then you're generally making more money than you're losing. Then you'll have profits, so you don't have to worry about the losses and be happy about the profitable trades individually. You just look at the big picture when you have Forex Robot. So those are the two main game-changing advantages that Forex robots bring. It's not to say that manual trading is not a great option, is not something that you want to pursue. Definitely, you have to start with manual trading, and some people just stay manual traders because they get passionate about it and they love what they're doing and they genuinely enjoy trading the charts. However, just keep in mind that there is this option of trading with Forex robots, and maybe you might want to check it out at some point through your Forex trading journey. Thanks for your attention. I look forward to seeing you next time, and until then, happy trading.